Hello, my name is Eric Lund. I'm a senior economist here at the Conference Board, and welcome to this month's Economy Watch webcast. Today, we're going to be talking a little bit about the U.S. housing market and structures as well as giving you an overview of our current outlook for the U.S. and global economies. Hello, welcome back. We're going to, as mentioned previously, discuss the U.S. Economic outlook as well as the global economic outlook today, as well as dive into some of the minutiae and trends that we've been seeing in the U.S. housing market. Some of the key questions that we're going to be asking today include the key drivers for U.S. residential and non-residential investment in 2020, how sustainable these trends are, what they mean for the U.S. economy, and of course, what the implications are for U.S. Businesses like the ones that you all work for. We also want to note that we are offering CPE credits today. Please enter your name in the appropriate box on the lower right-hand side of your screen. Make sure to watch the entire live program, and make sure to click the 3 pop-ups that come up periodically over the next hour. I'm joined today by the Senior Director for Economic Research here at the Conference Board, Ottoman Alzildrim.
Good morning,
welcome.
Eric.
As well as Mark Palem, Deputy Chief Economist and Vice President at Fannie Mae. Mark, welcome.
Having me on today.
And Ken Sibinson, Chief Economist for the Associated General Contractors of America. Welcome on, Ken.
Thank you. Glad to be with you.
All right, we're going to dive right in. Our first section is going to be on the U.S. economy and the global outlook. The U.S. growth drivers have been changing over the last several quarters and will continue to change in 2020. For the fourth quarter, U.S. GDP grew at 2.1%, which was about the same rate that we saw in the third quarter, but the drivers shifted quite a bit. Consumption is becoming less of a driver of growth, and other factors are starting to step into its place. The U.S. leading economic index that we produce here at the Conference Board was weaker in December, and the 6-month growth rate is remaining somewhat negative. That's nothing to be too alarmed about currently, and is consistent with our 2020 GDP growth forecast of 2%. Growth numbers for December came in stronger than most analysts expected, including us, but we expect that number to drop off over the next several quarters as income gains begin to soften somewhat. Manufacturing was another interesting observation over the last several weeks. The U.S. ISM Purchasing Manager Index was up quite starkly for January, and we're curious to see whether or not that continues over the next several months. Housing starts is also something that we've been watching quite closely. Since last summer, we've seen starts and authorizations increase dramatically. And we've also seen a pickup in the amount of spending that's showing up in the GDP data for residential investment. We're going to be discussing this, of course, in much greater detail over the next hour. Finally, with respect to monetary policy and inflation, relatively no news is good news on this front. We don't expect to see the Fed make any major changes to their policy over the next several months through 2020, in fact, and inflation continues to be quite under control. I'm going to hand over some of this topic to Ottoman to talk a little bit about the individual components of growth and what we're watching for in the U.S.
Great, thanks, Eric. So yes, I'll be sharing some of the data that we're looking at that's underlying this outlook. Eric mentioned the leading economic index. The LEI is a short-term indicator that we track at the conference board, and it's really a barometer of future economic activity. So it's looking ahead over several months, 6 to 9 months, and it gives us an indication of where the business cycle is and how it's going to be shaping up, and whether we're seeing any turning points in that. So in the recent months, in 4 of the last 5, we did see some weakness, some negative monthly changes in the LEI numbers. But this is really not something to signal an imminent recession in our interpretation. We've seen similar slowdowns, moderations in the growth rate of the LEI, 2 times already in the past during this very long expansion that we're in. We're in the 11th year of a business cycle expansion, and we don't see an imminent end to that. In the chart, you see the blue line, which is the LEI growth rate that drops substantially into negative territory ahead of recessions, which are the shaded areas. So in comparison, that really puts that in context. One more thing to note there is the red line, which is the companion index to the LEI, the CEI, Coincident Economic Index. These are indicators of current conditions, and that's still in positive territory. It's still growing. That's supported by labor markets, consumer spending. So the U.S. economy really ended the year on strong footing, and we expect we expect the expansion to continue, even though there'll be some changes in the sources of growth. So if we do look at where consumers are coming from in the next chart, December showed us a pickup in consumer spending activity. That's good news. But looking ahead into 2020, we don't see a big boost in consumer spending for the overall growth in the U.S.
And we did just have that really strong job report that came out last week ago. And a lot of this increase in this strength in consumption that we've been seeing in 2019 was related to wages and a tight labor market. We're expecting that to loosen a little bit. It'll still be tight, but not quite as tight in 2020. And that will sort of deflate the degree to which we're seeing consumption really push the economy forward. What about the manufacturing sector, Autumn? And what can you tell us about what's happening there?
Right. So the manufacturing sector actually is the main source of the weakness that we were looking at in the LEI, and the industrial cycle has been on a downswing since about the end of 2017, 2018, and industrial activity has been pretty weak. This is actually a global phenomenon. We see this starting in China and then traveling down the supply chain. And I think it's also underlying a lot of the pessimism that we get from the business side of the economy. So business leaders have been pretty pessimistic and really worried about recession risk compared to consumers. Now, that weakness, we've been arguing for several months now, is going to recede, and the industrial cycle will bottom out and then recover in 2020. And that's underlying sort of our outlook for a slight pickup in 2020 in our baseline scenario. And we started to see that in the manufacturing surveys. The non-manufacturing side of the economy was still in expansion territory, as you see in this chart. But the manufacturing responses in the supplier managers was in contraction, and that was worrying for many. But that has started to kind of bottom out, and
even tick up a little bit according to the most recent numbers. I mean, we're over 50 again on the ISM PMI.
Exactly. Yeah. So we are kind of expecting that to be good news for the economy going forward.
Why don't we talk a little bit about our sort of big picture thoughts on the economy? I know that we mentioned about 2% growth is our estimate for 2020, but that mix is changing, right? We're looking for, as we mentioned earlier on, the consumer to contribute a little bit less. But on the flip side of that, the business confidence we think is going to improve, and we're expecting a little bit more investment from
Right.
businesses and things like structures and things like equipment. And then, of course, we've been seeing some strength in residential housing as well, which we think is going to provide a bit of a tailwind.
Right. So that's what we're seeing in the leading indicators. So the weakness in industrial cycle is receding, and it's going to start providing more support for the economy in 2020. While we do see some softening on the consumer side, which has been really supportive of economic growth. So the sources of growth are changing, but the leading indicators are still consistent with about 2% growth for the U.S. And that's really around the long-term potential of the U.S. economy. And it's trend growth, and trend growth is not very exciting. So it doesn't feel like a boom, but it does show sustainability in the economic growth looking ahead, although we are talking about those changing sources.
Now, could you talk about a little bit about the global economy more broadly? We just focused on the U.S. What's happening outside of the U.S.? What's our outlook for 2020 and even further down the road?
Yeah, a lot of the cause for concern and the concern about recession risk was actually coming from the ability of the global economy to generate growth. There was weakness in Europe, there was weakness in Japan. Even emerging markets were softening, and China has been kind of in a long-term moderating growth path. So all of those things were feeding into a concern about the global economy. When we look at the global aggregate numbers, we saw that softening. A lot of it is, again, in manufacturing, and it was impacting the outlook for the U.S. But again, there we're beginning to see some improvement as the industrial cycle improves. Trade conditions are likely to improve. We don't expect an escalation of the trade disputes that was, again, creating a lot of lack of confidence. Some might call it trade policy volatility.
But now there are new kind of anxieties taking the place of these trade anxieties a little bit, vis-a-vis what we're all watching in the news, the coronavirus outbreak in China and some of the other countries that it's spreading to. Correct?
Exactly. So if you asked us, what is the one major risk to the global economy that you see? Looking at sort of the fundamental side of the economy, we weren't seeing a lot of recession risk, not a lot of sources of imbalances that might cause a downturn. So we would say, geopolitical risks are probably what might tip the economy to the negative. Black swan type events,
Sure.
Shocks to the economy. And now the question is out there whether this outbreak of the coronavirus in China could become a large enough shock to the economy, especially if it lasts longer and spreads outside China, could become one of those risks.
Sure.
But it is still too early to tell.
Well, it's certainly impacting the
data
Chinese
yet.
economy. That much everybody here at the conference board agrees on. We're trying to determine how much it is impacting. But one of the questions that, of course, a lot of U.S. executives have is what is the impact on the U.S. economy? And so we actually have a poll question on that I wanted to bring up. Can we pull that question up, please? Great. So for you who are watching, we love your input on this hot topic that we're all tracking quite closely. Do you expect the coronavirus outbreak to have an economic impact on the United States in 2020? We have three different options. It will hinder growth, it will have no impact, or it will, ironically, boost growth. Let's give you all a few seconds here to lock in your votes. And let's go ahead and cut that off if we can in the studio. All right, so about 60% of you are thinking that this is going to hinder U.S. economic growth. About 34% is have no impact. And a lonely individual thinks that it will actually help to boost U.S. growth for 2020. Any thoughts or reactions, Ottoman?
That's actually somewhat surprising because, as we kind of debate the impact, so far we see it limited to the Chinese economy. Might get a big hit in the first quarter, maybe spills over to the second quarter. but also creates sort of a lot of pent-up demand and conditions for a rebound later on. And so far, what we've been looking at suggests that it would be limited to China, and it wouldn't be kind of rippling out beyond sort of the emerging Asia.
Yeah.
So the pessimism about the U.S. is actually very surprising to me in this case.
Ken, do you have any thoughts on this?
Yes, I think that for now, we're not seeing an impact on the U.S. economy. I watch construction closely, and I think the resort, hotel, luxury retail sector does have reason to be concerned. And so if the Chinese travel remains shut down, either by their choice or because we're keeping Chinese visitors away, this could cause not only some distress in those sectors, but a spillover into construction plans by those kinds of
That's
firms.
an interesting observation.
More broadly, I don't think the U.S. economy is at much risk, although there must be some particular manufacturers that are worried about their supply chains.
No, definitely. Mark, do you have any comments to make? I'm sorry, Mark, yes?
I guess for the mortgage market, it's another occasion when low treasury rates and it allows people to refi. So I'm not saying we're having a big refi boom, but it is creating an opportunity as you saw the 10-year rate come down in the 1.5 people to refi. We've had waves of this in 2012 with the euro crisis and 2016 with the drop in oil, and at other times where global events actually create an opportunity for U.S. homeowners.
So maybe that lone individual who said that this would be good for the U.S. economy, maybe that's what they had in mind. But speaking of
they're hitting send on their refi.
Yeah, the silver lining, exactly. Speaking of the impact on the housing market, let's go ahead and dive into the second session because I want to listen to both of your thoughts on this topic. I'm going to introduce it briefly, but just going over some of the big picture data for building in America. So what we've really been seeing in 2019 was a pretty a fairly sizable, in the case of structures, slowdown in growth according to national accounts GDP data. If you look at the chart on the screen, you can see the black line represents GDP growth on an annual basis. The light blue represents residential growth, and structures is the orange number. And so really since 2018, we saw residential dip down to slightly below zero, where it stayed in 2019. But with structures, we really saw a pretty sharp slowdown for last year. And if you look at these numbers on a quarterly basis, the negative growth in structures remains, but we have seen a bit of an uptick in residential investment, which is encouraging. In terms of how important these two facets of the economy are for overall GDP, we've gone ahead and tried to take a snapshot of what share of total growth or total the U.S. economy these two areas account for. And what we've really been seeing is that the share of total GDP has actually been dipping a little bit. In 2015, residential and business structure investment represented about 6% of total U.S. GDP, but that's dipped down to about 5% now. But as I mentioned, we've been seeing in some of the more recent numbers some reasons for optimism, and we're going to go into those in more detail.
But those shares could be a little bit misleading because construction activity is actually a leading sector for the overall economy, right?
Sure.
So you undertake construction, and then it leads to a further activity down the line.
That's true.
And you build a house, and you have to furnish it and buy appliances.
That's definitely true. Yeah, this is more in terms of the actual construction that's being done, as opposed to these kind of downstream effects that result from it. One of the reasons that we decided to host a webcast on this were some pretty strong numbers that we've been seeing really since last summer with single family home authorizations and starts. In fact, the most recent data point for housing starts is really the strongest, I believe, that we've seen in about 13 years. So just because you break ground on a house there's a fair amount of economic activity that takes place after that, that first shovelful of dirt is pushed out of the way. So what we're expecting to see is stronger residential investment numbers over the next several quarters that follow from these strong starts numbers. But we want to get your perspective on this as well. So we're going to ask you another poll question, and then we're going to hand it over to Mark to talk about the residential sector in a little more detail. So how do you expect residential housing construction activity to perform in 2020? Do you expect it to improve? Really no change from 2019? Or are you a little bit concerned and think it might actually worsen from last year? Let's give you one more second to put your conclusions in and lock that up for us, please. So it looks like about 44% of the audience expects this residential housing construction to improve. Oh, can we lock that up, please? There we go. Yeah, about 40% think an improvement. Interesting, about 50% no change, and only, again, one only person thinks that it will deteriorate slightly. So maybe not quite as optimistic as we are. Mark, do you have any input on this? What are your thoughts on the big picture concept of how the residential market's going to perform this year?
So we are expecting that forecast. It'll make a positive contribution to GDP, a pickup from where it was in 2019, which is good. You're really seeing the effect of a drop in mortgage rates, and you can see that on the first slide of home sales, slide 17, where if you look at where we were at the end of 2018, when mortgage rates were 150 basis points over where they are now, since then, over 2019, you saw a really strong pickup, particularly in new home sales. They were up over 20%, and then existing home sales were up 6% during the year. Now, that pickup in new home sales was partly driven by the fact that you had some inventory issues. Inventories got built up for builders. They had to work down that inventory, and the reason I bring that up is because that strong starts number you were just referring to. The reason we've seen such a strong recent pickup in starts is partly due to the inventory factor going into that. As you can see on the next slide, one of the things that the builders have been able to do is change the mix of the type of homes that they're building in order to deal with the widespread affordability issues. As I'm sure all your listeners and viewers are aware, we've had a continued increase in home prices this cycle since they bottomed out in 2012. Home prices have grown substantially more than incomes, and that's also true on both the existing and the new home side for a good part of this cycle. But as you can see on this chart, builders have responded to that by shrinking the size, the floor area of the new homes that they're building. That's in red. Starting in about 2016, you see that starting to come down.
So
in
Mark,
order to be able to...
Mark, does this mean that the uptick in starts that we've been seeing maybe won't have as big of an impact on the overall economy because the size of the units are actually going to be a little bit smaller?
That'll definitely be part of the impacts, and it's good to draw that out. It's the flip side of making the unit more affordable, right?
Mm-hmm.
You can see that average price now is moving sideways at a little under $325,000 for a new home sale. And that's the way builders are making it pencil out, so it's still profitable to build given what's happening to labor costs, land costs, and materials. The other thing I mentioned was what was going on with inventories and the inventories of homes available for sale, and you can see that on the next slide. Sticking first with new home sales in the red line again, you can see how those inventories built up at the end of 2018 with the rise in mortgage rates. And since then, they've come back down. The other thing that's really noticeable and is affecting the market across the country is the inventory of existing homes available for sale remains low. And so that's partly discouraging buyers. It's making it harder for people to find a home, an existing home to buy, which is obviously what first-time home buyers in particular buy. So if you take these factors together, and I mentioned in the introduction what was happening with home prices, you can see on the next slide we've provided home prices by price tier within each metro. And you can see the strong pickup that happened in 2012, 2013, but then the continued pretty strong home price appreciation, particularly at the low end of the market or the entry point, where for a number of years you've had home price appreciation of 10%. But that has moderated in 2018, again, because of mortgage rates going up, and you saw a slowdown in the rate of appreciation. With rates coming back down, 2019, that slowdown has stopped, and now home prices are sort of going sideways, the appreciation.
So with that tight inventory market and these low rates, and that's also one of these drivers that's going to be pushing builders to break ground on new units, right?
Yeah, and it'll be partly dependent on what happens to mortgage rates this year. So our forecast has them being flat for the year, which would be supportive of housing. And as is the case for your macro forecast, we also have decent consumer spending and the residential fixed investment helping to make up for a little bit of a slowdown in consumer spending, but still positive.
Do you think that it's our thesis that wages are going to grow a little bit more slowly in 2020, as the tightness that we've been seeing in 2019 mitigates to a certain extent? Does that reflect the views that you have at Fannie as well?
Yeah, that's pretty consistent. I mean, if you look at the JOLTS data, you start to see a little bit fewer job openings. We haven't seen for a couple of months as strong wage growth, even though the last employment report was pretty good for wages. So it's really one of the risks to the forecast, and we sort of refer to it around here about maybe there might not be a Phillips curve anymore, but it's probably a line with a kink in it. We're waiting to figure out where that kink is.
Yeah, you're not the only one who questions the Phillips curve these days. Your next slide is actually pretty interesting. It has to do with deviations from trends, and would you walk us through this figure?
Sure. So obviously, with the pretty strong home price appreciation, I just went over in the last slide, and the fact that home prices have been rising faster than incomes, it raises the question about how sustainable are the price of appreciation and how deviated are we from fundamentals. And of course, there's all sorts of different ways to measure fundamentals relative to income, relative to rents, and et cetera. But what I've done on this chart is just to try to provide a fairly simple, straightforward measure of how prices are doing, taking the trend line of home prices for 91 through the present, and you can see that in the blue line, and then showing you the actual home price index, in the black line. And you can see that at the peak in the last cycle, we were 24% above trend. Now we're about 10% above, and then I've given you our forecast. So it's not anything like as deviated as it was previously, but we are above trend with the type of appreciation we've had. And if you look at measures of affordability, be they cost burdens and other things, homeowner affordability is reasonable. A place where you've really seen a lot of affordability challenges in the rental market, where you've continued to have a decent amount of rent increases. And unlike homeowners, they haven't benefited from the refi wave, right? So homeowner cost burdens have really been, on the one hand, you've had home prices go down up, but you've had mortgages come down, so the lower mortgage rates have helped attenuate that.
So earlier, I was arguing that we don't really see those imbalances or risks kind of building up in the leading indicators. And this is really the sort of thing that I have in mind, right? So that deviation away from the trend is not as large as we saw before the previous recession. So this would actually support my argument, and it's great to see this.
Yeah, and as we look out at the economy, I think it's the consumer sector, obviously in the tails, there are some issues around student loans. We saw a couple of years ago subprime auto delinquency rates go up. But by and large, the balance sheets of most consumers are in a lot better shape than they were in the prior cycle. And that's a combination of people reducing their debt levels, but also the benefit of lower rates. So thinking about imbalances, it does seem you look at some other sectors in terms of covenant-light bonds and the level of debt in the corporate sector and number of corporate bonds, publicly traded ones that are, triple B. That seems to be the area where you've seen a more taking on of risk and leverage. But turning back to the housing market, one of the questions that has been a focus of is there was a real drop-off in mobility coming out of the recession. So on the next slide, what I provided is a breakout of mobility. It's a percentage using data from the ACS, which is the government survey by age group. We look in this chart about people who say that they're an owner, whether they've moved in the previous year. And you can see from the top line, which is those under 30 in blue, that their mobility really started dropping off after 2004. And I think that was partly the run-up in home prices. And it bottomed out in 2011, and their mobility has really returned to more historical patterns. So even though overall U.S. mobility has not returned to historical patterns, within age group it has, which suggests to me that the type of demand we're seeing in the housing market is probably pretty close to as good as it's going to get, given this kind of age profile and the fact that unemployment is where it is, right?
Interesting.
The next thing I wanted to highlight is what's going on with affordability in terms of the structure of the household, and to go back to the question of are prices out of alignment with fundamentals. One of the reasons home prices have been able to appreciate as much as they have is with the employment pickup that we've seen in this cycle and the strong, the finally starting to see, substantial employment over what we had before the recession. You really have earning power in terms of two-income households to be able to afford and pay at the margin for the home prices that we've seen. So what this chart does is it looks at the ratio of median home to median income. And that's the black line going back to 92. But then we also break it out for one earner households versus two earner households. And the point being that if you look at the overall ratio, it's at 4.1 currently, which is higher than it was before the bubble at 3.4 or at 3.4 in 92. Then if you look at that bottom line, the two earner households, you can see their ratio of income to home prices is not that out of line of where it was in historical norms. You contrast that for the one earner households, where it is pretty high there at nearly 5, and is meaningfully above where it was in the early 90s all the way through the early 2000s. And so I think that's part of the affordability challenge you're seeing is really the difficulty for one earner households to be able to afford a home.
So, Mark, in aggregate, what does all this mean for 2020 and for 2021? I know that you have some projections that have been put together. Could you walk us through what you think is ahead?
Sure. So overall, the next slide here provides our forecast, and we do a monthly forecast that we put out on the web, obviously available for anybody, and check back in and see how we're doing and see how the housing market is doing. But you can see, as we've discussed now, we have a decent pickup in terms of housing starts for this year over last year, 6.6% the first line, and then, continuing into 2021. That's being driven by really the new side, the multifamily side, the single-family side. The multifamily side has done well. It's had a much stronger cycle this time. Single family is still playing catch up with historical norms, but it's making strong advances. If you're looking what that means for home sales, you can see we've got home sales, new home sales up 5% next year and the following year, just because there's still a decent pent-up demand, and we're looking to get back closer to historical norms. Existing home sales are much slower pickup, partly because of the affordability issues and just the lack of supply in the existing home sales number. And then on home prices, we've got it 4.6 for 2020, and a little bit of a slowdown in 2021. Again, it's just the affordability issues really constrain, and the deviation from the fundamental makes us a little bit more cautious about 2021. And then below that, you can see our mortgage origination forecast.
Okay. So on the whole, probably good news from residential, the residential market, single family and multifamily for 2020, and a reason to be optimistic about U.S. GDP growth that's being derived from this part of the economy. But again, we have the flip side of this. We have the non-residential side as well. And we wanted to give the audience an opportunity to talk a little bit about, or to think a little bit about this. Can we pull the poll question up, please? So how do you expect construction of non-residential structures to perform in 2020? Are you as optimistic about that side of this equation as you are about the residential side? Do you expect an improvement, no change, or worsening for non-residential structures in the current year? And let's give the audience just one more second to lock in their votes. So let's close that poll. All right. So about 38% of you, 39, expect some improvement. About 44, no change. And about 16% expect things to get worse. So for context, the year-over-year growth rates that we've been seeing out of the GDP data have been negative for a little bit. We were a little bit optimistic about things turning around, but why don't we have Ken maybe walk us through his vision, and he follows this extremely closely. Ken, why don't you talk a little bit about your response to this audience poll, and then we can go into some of the material that you've prepared for us.
Okay, great. Well, first let me mention that I'm the chief economist for the Associated General Contractors of America. That's the leading national construction trade association. And we have about 27,000 members who collectively build everything other than single-family housing. And of course, I do keep a close eye on that too. We do a poll every fall of our membership about their hiring and business outlook. And for me, the key question is, do you expect the dollar value of projects to increase or decrease relative to last year? And this slide shows the results of our 2020 survey, and then beyond the slash mark, our 2019 survey. We asked about 13 different business segments, and the figures here show the difference between the percentage who said the market will be stronger this year minus the percentage who say it will be weaker. We call that a net reading. So the very first figure you see there, 25 percentage point more people saying that there will be growth in water and sewer construction than think there will be a decline this year. Last year, they were also positive, but only a plus 14%. And going down the categories, we now have 20% net positive reading on bridge, highway construction, K through 12 school, hospital, all other forms of transportation infrastructure. All of the other categories also positive in both years. Everything on the left-hand side and the top of the right-hand side more positive than last year. Now, my own view is not quite as rosy as that. I think that for 2020, we will see non-residential construction at least match last year's figures, perhaps come in a little stronger. These predictions and the actuals are from the Census Bureau's value put in place, or construction spending numbers. They're not adjusted for inflation, and we have had some significant uptick in both construction materials costs in 2018. That kind of reversed in part, leveled off in 2019. But then contractors were playing catch up with the surprise increases they've been hit with from tariffs on steel and aluminum in 2018. And so their bid prices, as measured by the Producer Price Index for new non-residential construction, that was rising more rapidly in 2019. So if we could put all of these different measures in real terms, such as square footage, you might not have seen any increase in either year. And looking at the 2020 forecast, I have given myself a fair amount of wiggle room. That's partly because of uncertainty over the economy, but also because these estimates are somewhat frail. The census revises them 1 and 2 months out for each month, and sometimes fairly significant adjustments. In fact, they have just named a working group to try to improve their construction statistics. I'm going to be leading that initially, so I'd welcome input from any listeners on things that should be changed. Taking a brief look at these categories, and these are ones as defined by the Census Bureau. A couple are kind of quirky. For instance, power construction actually includes not just every form of power generation, transmission, and distribution, but the separate areas of construction in oil and gas fields, other than the wells themselves that count as mining, and then pipeline construction. And so I think there will be strong growth this year in wind, solar, perhaps some offshore wind off the Atlantic coast for the first time, and pipelines, although the timing on pipeline construction always depends on court and regulatory decisions. Another strong category should be highway and street construction. As you see, it did pretty well in 2019. We finally now have 33 states that have boosted their gas taxes or other sources for highway construction, and those tax revenues have been phasing in, and we're now seeing a lot more bid lettings. We're also seeing more toll projects, both from traditional toll authorities and public-private partnerships. So that should be a good category this year. Thirdly, I think the broad transportation category, airports, transit systems, ports, and rail, a little bit of trucking, that should do well. We've seen several years of growth in airport construction, still lots of activity. Any of you who are flying through hubs or other airports see that all the time. But I think we've may have reached maximum level of that. Instead, we're seeing ramping up in transit construction in the LA area, the Puget Sound area, some smaller systems, and major reconstruction, Chicago, the BART system in the San Francisco Bay Area, the Green Line in Boston, and so forth. The one really weak category both last year and this year, retail construction. With a record number of store closures announced last year, that's to be expected. Perhaps the one surprise here is warehouse construction went from the strongest category in 2018 to flat last year. There's still plenty being built, but it is much more in the category of the click and collect or last hour, last mile kinds of facilities inside metro areas. They're on more expensive land and cost more, but they're much smaller than the massive distribution facilities that Amazon and others have been building. Very briefly on the residential side, after years of doubting that we would see as much single-family construction as the home builders and the realtors were predicting, now I think I'm a little more optimistic than they are. I think that the low interest rates that look like they're going to stay in place for some time, that's going to lead to a surge of home buying and therefore home construction. And normally you might think that that would be negative for multifamily, but some of the people who are going to be selling homes now that they no longer feel rate locked, that they had what looked like a really sweet 4% mortgage and instead they can get a 3.5 or 15-year 3% mortgage, they're going to be moving from single-family homes where they have to shovel snow and cut the grass and fix the roof into apartment buildings. A few into condos, though the condo share of multifamily staying very low compared to what we saw before the recession. But at any rate, I think multifamily will do well. Moving on to the labor market situation, which is the biggest concern for contractors. This is a map I update each month that shows change in construction employment, and it's been pretty positive. This December figure, 2/3 of the states had increases, 1/3 down. The colors move around from month to month, but basically we've seen anywhere from 34 to 43 states have increases in construction employment. And yet contractors say they're having difficulty filling positions. And indeed, the job openings and labor turnover survey that was mentioned earlier, while we have seen a downturn in the last 2 months, this snapshot shows that until This was the November figure. We have December numbers out yesterday. Very similar picture. Record job openings, almost matching the actual number of people hired in 2018. Backed off a little bit in December of this past year, but nevertheless, contractors would be adding far more workers than they were actually able to hire if they could find them. And indeed, our survey found that 75% of firms said that they were planning to add workers this year, but 81% said they had difficulty filling positions last year, and about 2/3 think that it'll be as hard or even harder to do so this year. Consequence, as you might expect, costs were higher than companies anticipated for nearly half the firms, and so almost as many say they're now putting higher prices into their bids or contracts. Almost as many, 40%, said projects took longer than anticipated because of those difficulty filling positions and having to rely on people doing overtime or less experienced workers whose productivity is less than what they had. And not shown here, but 23% of the firms said that they're now quoting longer completion times when they can. That's not always possible. You have to open a school or a store by a certain date. Lastly, firms are turning to technology, labor-saving equipment. They're using methods like building information modeling to try to reduce the amount of on-site work time. And a few firms are adding specialists who traditionally did not work for construction firms themselves. If we could go on to the next slide, I think this shows the change in cost that I mentioned. The producer price index for all materials and services inputs had a big bump up in 2018 and then has kind of leveled off in the last year. Cumulative increase over 4 years, almost 13%. Labor costs, shown by that red line for average hourly earnings, went up at about the same rate, cumulative increase of 13%. And then the black line shows that bid price index, what contractors say they would charge to put up new buildings. That has, at first, they were caught by surprise. Their bids weren't going up and their costs were rising. Over the last year, they have caught up, wound up at about the same place, just under a 14% cumulative increase over 4 years. I think all this is coming as a surprise to many owners who see consumer prices up just 8.5% over that time. Lastly, let me show you my summary slide of my forecast for the outlook. I think total spending will be up modestly this year, driven mainly by a good growth in residential spending, both multifamily and particularly single-family home building, public and private non-residential at worst flat, perhaps up at a 4% rate as we saw in 2018, and a rebound in the price index for goods and services inputs, although perhaps if the coronavirus holds down demand for inputs such as petroleum products, steel, and aluminum, we'll get another subdued price increase. Wages and salaries going up more rapidly, and the real labor costs involving higher search costs, higher training costs, and so forth, higher unit labor costs, certainly more than they had been. So let me turn it back to you, Eric, and Adamon.
Thank you so much, Ken. That was a really deep dive and very interesting take on the non-residential market. Ottoman, did you have any thoughts on that?
I do have one question to Ken. This is really fascinating, and it's not really directly related, perhaps, but your slide on the labor-saving methods hints that there is some potential for improving productivity. And as many of you know, productivity is kind of the underlying source for sustainable growth for the future. And when we look at the macro numbers, there are some indications, early signs that productivity, which has been weak for, say, a decade, is starting to pick up. So would you comment on that a little bit, whether structures investment has some impact on productivity that we might expect looking ahead, both in the structures construction sector, but also for the larger economy, Ken?
Sure. I want to give a shout out to the Office of Productivity and Technology in the Bureau of Labor Statistics. They have a team who have spent years trying to disaggregate the construction data in order to dispel this or check out this urban legend that construction has zero or negative productivity. And indeed, they found that over a limited time period that they've been able to examine so far, there were significant productivity improvements, particularly in industrial construction, but also to some degree in highways, single family, and multifamily. They're extending that work, but it is a slow process. What I see happening when I talk to contractors, invariably they have examples of equipment, of using off-site manufacturing for components, of methods such as lean construction that improve their productivity, but they are kind of fighting an incoming tide of ever less experienced workers. So the labor side is definitely a weak point, and we'll have to see which of those competing forces wins out in the near term.
Well, thanks very much for that, Ken. Productivity is a pretty, of course, important topic, but it's one that Ottoman spends a lot of time thinking about as well. But we're actually getting up towards the conclusion of the hour, and we don't want to keep anybody past noon. So thank you all very much for joining us today to talk about this interesting topic. Next month, we'll be tackling the U.S. Presidential elections. We're not going to be forecasting who's going to win, but we will be talking about the potential implications both for the economy and how the economy feeds into possibly what we could see in terms of the outcome. So make sure to put that on your calendar. And that's all from us here in New York. Thanks so much for joining us, and we look forward to seeing you again.